Well, despite the best efforts of the Prime Minister to soothe the anxieties of investors today, Australian shares shed more than 4%. The market slide compounds losses for local shareholders, who have already seen the value of their investments fall by around 35% since the onset of this global credit crisis. So is there more to come, and what does it mean for investors and superannuation? Greg Hoy reports.
Some 16,000 kilometres separate the soaring skyline of New York from Sydney and Melbourne. But the defeat of the US financial rescue package has sorely tested the popular contention the US and Australian financial capitals are such a safe distance apart, indeed a world apart in terms of standards of prudential regulation, so as to protect Australian investors and the public as the credit crisis gains momentum without a long pocket lifeline from Washington.
We've lived a 20-year credit bubble, and it's going to be very difficult to see that bubble deflate without some macro pain. And my view is we won't be able to avoid it. We will see asset prices decline, and that includes house prices, and we'll see it on a fairly broad-based front.
Following the surprise no vote from the American Congress, locally, while some seem relaxed, investors around Australia today awaited the inevitable reverberations from the shockwave that struck Wall Street overnight. The anxiety of most was obvious.
I'm a retiree and dependent on that as part of my income. Watching my fortunes going down, I suppose.
In Australia, we've always had a softer landing than the Americans. For example, today, as I speak, the markets are down 3.5%, whereas overnight in Wall Street they've been down 7%.
When I look at the losses at the moment, it's only a paper loss to me. As I said, I don't intend to sell. I'll just sit and wait out the storm. It'll come back. Always has.
Already, investor pain in Australia has been considerable.
The Australian share market is down roughly before today about 33 to 35%. If I had 100,000 and I was 55 years of age, I've now got 60,000. I mean, my retirement suddenly becomes problematic.
I know in some cases people have said, well, they'll have to work a little longer, and that's unfortunate, but maybe that's a fact of life.
Like the federal government, the Australian Shareholders Association is urging investors to hold their nerve and resist the temptation to crystallise losses.
I'd say don't panic, particularly those in retirement who've got 15 or 20 years. They've seen this all before, and they know that in the longer term markets will sort themselves out. I think we've got to remember that for about the 4 years prior to this year, there was about an average of 20% a year increase in their portfolios. So one must expect that there will be some downturn every so often, and unfortunately it's occurred.
Of course, the pain is not equally shared amongst retirees and would-be retirees, depending on how diversified their investments are between the 4 asset classes, namely cash, such as bank deposits, cash management trusts, 90-day bank bills, etc., term deposits, such as infrastructure bonds, debentures and government securities, shares and various types of property investments. It's true to say that of these, cash is king. One way to stay in the black at least, but not by much.
If I'm in a cash account earning 6.5 and inflation's 4, I'm really only earning a net 2.5. I'm never going to get wealthy that way, but I am going to preserve capital. The remaining 2 asset classes are property, and that's direct property or property funds, and of course shares. If you're exposed to shares and if you're exposed to property, you have red ink all over you at the moment.
Those who have for some time been bearish or pessimistic in their forecasts seem to have been vindicated, and they say the Australian public should brace for further pain, even if the US government's rescue package is resurrected.
Even if we reduce that downside risk, the base case is still for a recession of 2 or 3 quarters in the US. We're still facing up to very weak growth elsewhere in the OECD, and we're still facing up to weaker growth in Asia. So it's not going to dramatically improve the global outlook, we're still looking at weakness in commodity prices, and for Australia, tightening in credit conditions that will affect business investment in Australia and will affect house prices, in my view.
Others are more optimistic.
Well, I think firstly we've got to get the legislation through in the US. Let's then examine what has really happened, and I think we'll find, particularly in Australia, that things aren't as bad as they appear to be.
I have no doubt the package at some point will come through, but at the moment, with it not coming through, there's collateral damage.
Meantime, there is an emerging view amongst analysts that the ongoing turmoil on world financial markets will leave the Reserve Bank of Australia with little option when it meets next week to consider interest rates as other world economies slide further towards recession.
I'm now expecting that our Reserve Bank will cut policy by 50 basis points next week. Our Morgan Stanley global team is expecting recession in the US. We think there's already a recession in Japan. We're downgrading our European growth numbers, and the UK looks like it's heading to recession.
That report from Greg Hoy.